most times when you look at, say, the market or more of a passive buy and hold type of portfolio, it's going to have a Sharpe ratio around 1, give or take. Like, it might be a little bit higher than that. It might be a little bit lower than that. But what that means is 1 unit of risk or 1 unit of volatility in order for a unit of return. And what really good portfolio managers and portfolio strategies will do is they're going to give you more units of return for each unit of risk or volatility. This is the Realize Your Wealth podcast by Aretec Wealth. We want you to be wealthy. We want you to feel wealthy. We want you to realize your wealth. All right, here we go. It's Friday. We're back. It's still the holidays. We're now into 2026. How you doing, Greg? Happy New Year.
Yeah, Happy New Year. We're right in the thick of the holidays. Just at the tail end, it was good. It was busy. It's a little bit of a blur. We were talking earlier. It was a little bit chaotic, but lots of fun. But I'm sure, however chaotic my vacation was or Christmas break was, probably pales into comparison to how chaotic it was for you and your household.
Yeah, it's busy. Look, it's a little tired. We're in here today, working. We're in the office, taking a little bit of a break from all the family stuff and festivities. No, but it was good. Look, Christmas with little kids, it's good. It's busy. Lots going on. Lots of activities. Lots of family stuff. We were back and forth from the cottage. We were out on the skating rink more than a few times with all of them, which is good. But no, busy. Lots of work. Lots of fun. It'll take me a couple days probably to acclimatize and get back to reality here. But no, it's good. How about you? How was Leo's first Christmas, Greg?
Leo's first Christmas was good. I think I said this before. He definitely doesn't understand what's going on, but he certainly is interested, helping everyone open presents, open the wrapping paper. He's interested by the lights. We did, because it was so snowy and stuff, we actually did take him. We have a little hill by our house, so we took him tobogganing, but he only lasted one run, and then we were back inside. We tried to do some of the Christmas winter activities, although not a whole heck of a lot, but I'm sure as the years go on, we'll be doing more of that stuff.
Oh yeah, well, it's cold. It's tricky for tobogganing. We were gonna go on New Year's Day, but it's cold, really cold, and then it's icy out there. So we've had I don't think quite enough snow to get that that going properly.
No, so it didn't work. But when we went, it was between Boxing Day and New Year's, and it was the wind. There's a couple like windy days. The wind was cold. Anyways, we dipped his toes into it, so sure we'll be doing more of that as the years go on.
Oh yeah, it's a real Canadian winter here so far this year. I think trying to remember when we started getting snow, but it was either in November or early December this year. So it's a cold. But it seems like it's going to be a cold and long winter so far.
It's funny how things work out. You'll remember, obviously, from us doing this for the last few years, a couple winters ago, for the last few winters, it hasn't been that snowy, so we haven't been able to get out cross-country skiing as much. But now the weather's, it's more snowy, but we have a baby, so we're still not able to get out cross-country skiing much. So it's a lose-lose, but it's okay.
Yeah, how's Leo going to, someone's got to carry him, I guess, or push him in a little sleigh.
So there's actually you can attach it to your waist, and then he can be in a little carrier behind as we cross country ski. But I think we agreed neither of us are that good at cross country skiing that we feel comfortable doing that. So I think we'd have to leave him at home if we got out.
Hey, it's all good. So no, good holidays so far. We're getting back into the swing of things. I think next week will really be things will be moving full steam. So I mean, how we kind of went the last week. I mean, September was sort of a mixed month, December here. I'm still getting my bearings. December was kind of a mixed month in terms of markets, and things were bouncing back and recovering, and then you had some weakness at the end of the month. Today, a little bit of strength, but kind of just not a lot going on. But this time, market wise, quiet period. We definitely didn't get a decisive Santa Claus run, but what we want to talk a little bit more about is really high level, kind of what we're very, very just touch on some of the stuff to look out for as we move into 2026, and then we want to talk about the risk return ratio here.
Yeah, and 2025 was obviously a really good year for our clients, investors, portfolio. There was a lot of kind of interesting themes and trends that developed. There was obviously everything that went on in the spring with the tariffs. I guess, and I think we're going to dive into this more, but I guess just now that kind of the playing field has been reset, like anything top of mind that kind of we're watching that you're seeing out there so far.
Yeah, I mean, look, I think as we move forward into 2026, a lot of the same themes are going to play out. So a big one which we've talked about is the AI and the technology theme and the whole potential boom and bust cycle there. Another big one is going to be what's going on with central banks and the Federal Reserve and interest rates and the state of the economy, Trump and policy and the whole U.S. landscape and the political landscape is going to be another big one overall. And I think for us, a big one has been and will continue to be the gold story and the materials landscape and the whole commodities complex when it comes to Canada. So those are all stories. That's a 1 minute overview. Those have been some of the big themes of 2025, and I don't think anything necessarily has drastically changed as we look out into January. There's going to be some economic data coming, some jobs numbers shortly, which everyone will be paying attention to. That's kind of next Friday. That has the potential to move markets and impact things. When you talk about interest rates, the whole Fed chairman, the Federal Reserve, that's going to be a story because more likely or almost certainly there's going to be a dovish central bank chairman coming in, whoever that is. And so that means the trajectory, or at least the bias, is going to be towards lower rates in the US, which for sure can be a good thing for markets and provide some economic stimulus. But also, what are the long-term implications of that if that's not necessarily the right policy decision, if they're cutting into an environment that maybe doesn't warrant interest rate cuts? So all things that we're going to be watching for, and as we kind of frame the 2026 perspective and strategy and outlook overall, we'll talk about more. But I think a lot of that dovetails, and we want to talk to more in terms of a process based discussion just around risk return ratio and what that means for investors and what that means for portfolios here.
Yeah, and one thing just to add quickly is like, as we sit here right now, we don't see any necessarily like new kind of trends or things like developing, but I think we'll kind of see a lot of the trends that started developing in 2025 play out. To your point, interest rates, inflation, Fed chair, like a lot of those themes are going to kind of continue to be flushed out in 2026.
Yeah, and I think a thing to be mindful of here is that we now have had three very strong calendar years in markets. So 2025 was a strong year, 2024 was a strong year, 2023 was a strong year, and the last time we had a negative year was 2022 when interest rates and inflation and all the fallout from COVID had taken over. So does that mean that 2026 is going to be a bad year in markets and a negative year? Not at all. But we're not exactly coming off a low base in markets. We're not. It's not like we have the potential there for recovery. It's a full blown bull market. How long that goes for, we don't know. At the end of the day, we do have a little bit more conservative positioning in portfolio now, partly for that reason, partly going back to technical indicators and what's going on. It's just to say that as these things drag out and you have more and more strength out of markets, it tends to decrease the likelihood and the probability that you'll have a strong year. That being said, what we got in March and April of this year was a pretty major shakeout and pretty major sell-off where you had a 20% correction out of markets, 20% crash driven by tariffs and policy and the whole liberation liquidation day and Trump. That's a reset that those don't happen every year. I think sell-offs like that, I mean, we certainly got one in 2022. We had one in 2020. We had one in 2018. We had one in 2016. That magnitude technically of those sorts of sell-offs, those happen really probably every 2 to 3 years. where you get a washout, and we did actually have one of those in 2025. So that's a good, healthy sign. That was the base and the rebound and the recovery that we saw this year. So, we'll see where things play out, but that's why we want to talk a little bit about this idea of risk return ratio.
Yeah, it ties in nicely because to your point, like this past year has been a great year for our investors, for our clients. Like the return has been really good. Not to say it's not going to continue to be good, but there's a couple other metrics that you want to look at, Will, like just purely on return, because that's kind of like the top line number. But then there's a lot of numbers that support that actually kind of help justify, what these return numbers actually mean.
Yeah, so some of our reporting that if anyone wants to look closely, and we've talked a little bit about this. I mean, we have improved reporting, improved metrics here at Aretec through Digit, which is great. And the numbers last year, 2025, were very, very good. The top line numbers, whether that's an absolute or relative number against the benchmark, just for pure performance, really across the board for clients, those were quite strong. But when you start to look at what the returns and performance, one of the risk metrics we want to look at is volatility. It's kind of the idea how smooth or how bumpy a ride it was. And when you look at, say, I don't know, the S&P 500, or even some of these areas that are really driving things, whether it's the technology stocks or certain AI stocks or higher risk, higher reward names, they tend to be quite a bit more volatile. What we mean by that is you could see them swing. You could see them swing up 20%. You could see them swing down 20%. I think what you saw with the more volatile areas of the market, you certainly had stuff that had huge returns, but then could get cut in half when markets get choppy. So that volatility number, think of that as almost like the turbulence that's going on. And I mean, you could have good returns, but you could have a portfolio that shoots up 20%, down 20%, up 30, down 10, like this. And that, I'm going off the screen here. That's a lot of volatility. And most people, when you think of that from an investor behavioral standpoint, even if you could get better returns, stomaching that kind of volatility is not something that investors would want. And I think the other number that sort of dovetails with that is the max drawdown. So kind of the peak to trough number. And so there's all sorts of names. Like if you were to look at, say, an NVIDIA or Tesla or any of these names that are in sort of this really growthier type of complex, they easily, whether it was in 2022 or in 2025 or 2020, that could lose 50% of their value or more when you look at peak to trough. And that doesn't mean their longer term performance hasn't been good, but when you think of it as investor, if you're sitting there and you had a portfolio that you invested was 2 million and all of a sudden it's down to $1 million and you've lost 50% of your value, not going to really feel good in terms of volatility, drawdown. So what we have seen historically, that our drawdown, our volatility tends to be in single digits, meaning that you're not seeing big 10% or more corrections out of the portfolio. You're not seeing peak to trough moves of more than 10%. If we can keep that in single digits, where you're looking at 3, 5, 7%, 8, 9% corrections, when the market is doing more like 20, 30%, that's good risk management, and that helps the risk return ratio overall.
Well, that also just helps the bottom line results, because if you're not seeing those massive drawdowns on the portfolio, it's going to give you obviously a smoother ride, but you don't have to kind of work yourself out of as big of a hole when the markets do start to recover. And we saw that in March and April. Our portfolio went down a little bit, but nowhere near as much as the markets. And then we don't necessarily need to take on that same risk to get those returns when markets are stronger.
Right. So with our strategy, with our process, if we can better protect the downside, which is what we're looking to do, it better sets us up in the recovery. It better sets us up in the rebound and the bounce back overall. So we do work with our strategy, our positions, trades that we're making, to try to mitigate within reason that downside, that volatility, the drawdown on the portfolio. And then it kind of dovetails into one of the numbers that we're looking more closely at, which is the Sharpe ratio, which is not really as well understood overall, but it's more of kind of an institutional portfolio management metric. a little bit more of a almost like a hedge fund type metric. But the idea there is how many units of risk are you taking on in order to generate a unit of return? And I think it's a better way to think about returns and risk because often people just think I'm a growth investor, I'm a balanced investor, I'm an income investor, or I'm a aggressive equity investor, or I'm a conservative income GIC type of investor, where that doesn't really tell the whole story. And what we try to do with our portfolio is we want our portfolio when the market's good to behave more like a growth or equity growth type portfolio. But when the market's not so good, we want it to perform more like a balanced or conservative income portfolio and to manage that risk return ratio. And the sharp ratio is a good way of identifying that, where most times when you look at, say, the market or more of a passive buy and hold type of portfolio, it's going to have a sharp ratio around one, give or take. Like it might be a little bit higher than that. It might be a little bit lower than that. But what that means is 1 unit of risk or 1 unit of volatility in order for a unit of return. And what really good portfolio managers and portfolio strategies will do is they're going to give you more units of return for each unit of risk or volatility. So if we can be above one in that metric, that would be a win. And what we've seen in the last year or so is those numbers in a lot of cases have been closer to 2 or 3. Some of that for sure is a function of markets have been relatively calm in the grand scheme of things. Performance have been good, results have been good, but we've also done a really good job of managing downside, managing risk, managing volatility. So we wound up with sharp ratios in the neighborhood of 2 to 3, which are really good numbers and really just elite institutional grade, institutional caliber portfolio management numbers when you look at risk return ratios.
Yeah, so you really just want to, of course, you want to get the return, but you also want to look at, okay, how much risk am I actually taking to get those returns? And if we can take less risk than the market, but get outsized returns, like that's really where you want to be.
Yeah. So I mean, 1 unit of risk for 1 unit of return is fine, right? I would say that's good enough, and there's not a really a problem with it. But if you're getting 2 units of return for every unit of risk, or 3 units of return for every unit of risk, that's very good. What that also means is you have a strategy that very likely when the market turns and the market goes south, which at some point, I mean, hopefully it's not anytime soon, but at some point we all know it will, that volatility will come back in the market. It means you're not taking on the same risk to generate the return. So a lot of cases it may mean you've gotten market type returns, but you've done that with significantly less risk and significantly less volatility, which I could tell you over the long run is a real value add for investors when they are able to generate that. So those are some of the metrics we have now available in the reporting, whether it's the Sharpe ratio, whether it's the max drawdown, whether it's volatility. And I think they're also, we want to drive results. We want to be drive bottom line and drive performance. But at the same time, we want to manage that risk and be mindful of how much risk we're taking on for investors to generate the returns. And that's what those numbers tell us.
Yeah, and really going back to your earlier point, Will, like investors and clients, they want to get from point A to point B in as smooth of a ride as possible. Investors, clients, they don't want to see their portfolios going up and down all the time. They want as smooth of a ride as possible.
Yeah, volatility is kind of like if you're flying a plane when we say turbulence, right? No one's going to want to get across the country where the plane is just going like this and you're holding on to your seats. I mean, think of the anxiety, and that's what happens with investors when there's a ton of turbulence, a ton of volatility in a portfolio. It changes the experience. It changes behavior. And when we can when we can get you to the same spot, or oftentimes a better spot, or do it faster, but do it in a smoother way, that means you got a better pilot really flying the plane, who's navigating the environment, navigating the weather, navigating the turbulence a lot better. And that's what really good, strong portfolio management will do for you. So it all ties in. Yes, we want you to be wealthy, which means great numbers and great risk management, and great bottom line results. But we also want you to feel wealthy. So when we get that smooth ride going in the portfolio, you're not going to be so worried about what's going on and all the ups and downs and the crazy changes in value. And ultimately, we want you to realize your wealth. That's what Aretec Wealth is all about. That's what we're here for. So happy New Year, everyone. Looking forward to 2026,
Yep.
and we'll be back with you next week.
Have a good one.